Welcome to TalkTickers, your shortcut to understanding the latest earnings calls.
Thanks for having me.
Today, we're diving into Procter Gamble's third quarter 2025 earnings call.
Right, P&G. We're talking Tide, Pampers, Crest, those everyday staples.
Exactly. They just share their latest results and outlook. And, well, it's a complex environment out there, isn't it? Consumer volatility, tariffs.
Definitely. But this report gives us a good look at how a giant like P&G is, handling it all. Their stability and strategy are always interesting to track.
So let's get straight to it. What are the headline numbers from the quarter?
Okay, so organic sales saw a bit of growth, up 1%.
Just 1%.
Yeah, pretty modest. Estimated total sales landed around $20.6 billion for the quarter.
And how did they get that 1% growth? Was it more people buying stuff?
Well, interestingly, no. The growth came pretty much entirely from pricing increases. Volume, so the amount of products sold, and mix, the types of products, were basically flat compared to last year.
Okay, holding volume flat isn't terrible in this climate, but relying on price, that tells a story. What about the bottom line, profitability?
Profitability looked okay. Core earnings per share, or EPS, went up 1%. If you strip out the currency headwinds, it was a bit better, up 3%.
And margins, always key.
Right. Core operating margin actually expanded by 90 basis points. That's 0.9%, mostly driven by productivity gains, getting more efficient internally.
That sounds positive.
It is, but on the other hand, their gross margin dipped slightly, down 30 basis points. So a bit of a mixed picture there on the margin front.
Okay, so overall growth is slow, driven by price, but they're managing costs to help the operating margin. Sounds like performance probably varied a lot across the business.
Exactly right. When you dig into the specific product categories, it's definitely not uniform.
Let's do that. Where were the bright spots?
Well, 7 out of their 10 main product categories actually held their sales levels or grew. The real standout was personal health care.
Oh, yeah. How much growth?
High single digits. Really strong performance there. Skin and personal care also did well, showing mid-single digit growth.
So health and beauty seem resilient. What else grew?
Fabric care, think Tide, oral care, Crest, and feminine care, they all had low single-digit increases, kind of keeping pace.
And the weaker spots?
Yeah, there were some slight dips. Family care, baby care, Pampers, and home care saw sales slip a bit year over year.
Baby care dipping is interesting. Personal health care leading. Maybe a shift in what consumers are prioritizing. Wellness, perhaps?
Could be. It definitely suggests that sector might be more resilient, even when wallets are tighter. Something to watch long term.
Definitely. Okay, so that's the product view. How did things look geographically? Was it patchy there too?
Oh, absolutely. Big variations across the globe. North America and the main European markets both grew 1% organically.
Okay, consistent, but like you said, modest.
Right. And for North America, that 1% is actually a slowdown compared to how they've been doing recently.
Any particular challenges in Europe?
Yeah, France stood out. Sales there dropped quite sharply, high teens, mostly because they were up against really strong numbers from the previous year. Tough comparison.
Got it. What about Asia?
Greater China saw an overall decline of 2%. But interestingly, their high-end skincare brand, SK2, bucked the trend with double-digit growth there.
So premium is still working in China, even if the broader market is down. Latin America.
That was actually a bright spot, grew by 6% overall, which is pretty solid, even with some difficulties they mentioned in Mexico.
And elsewhere.
The other enterprise markets felt some impact from the tensions in the Middle East. So yeah, a very mixed global picture.
It really is. Different stories everywhere. With all that variation, how did their overall market share hold up? And how are they managing the finances?
Good question. Despite the regional ups and downs, their global market share actually held steady. That's pretty significant in this competitive space.
Holding share is key. Any specifics on that?
Yeah, they mentioned that 27 of their top 50 category country combinations, so like Tide in the US, Pampers in Germany, that kind of thing, either held or grew their share.
Okay, so the core brands are holding their ground. And financially? Shareholder returns.
They definitely focus on that. Returned about $3 billion to shareholders this quarter. $2.4 billion of that was dividends, and $1.4 billion through share buybacks.
That adds up to $3.8 billion, not $3 billion.
Maybe timing or rounding in their report?
Yeah, possibly. The report mentioned $3 billion total return with those components. Anyway, the big news on the dividend front, they raised it by 5%.
Wow, another increase.
Yep. That makes it 69 years in a row they've increased the annual dividend, and they've paid dividends for 135 years straight. Just incredible consistency.
That's why it's a classic dividend stock, right? How's their cash flow looking?
Adjusted free cash flow productivity was 75%. It's decent, but actually a bit below their full-year target of 90%. They said that was mainly due to some inventory movements.
Okay, so something to watch, but the balance sheet is still strong. Yeah, they emphasize the balance sheet remains healthy, gives them room to keep investing in innovation and, keep those shareholder returns coming.
Which brings us to strategy. You mentioned innovation. What's the focus there?
They're really pushing what they call their integrated growth strategy. It boils down to three things: superiority, making better products; productivity, being more efficient; and constructive disruption.
Constructive disruption. Sounds like buzzword bingo, but what does it mean for them?
Yeah, it can sound like that, but I think it means they're looking beyond just small tweaks, thinking about new formulations, maybe new business models, new ways to reach people, not just incremental improvements.
So investing even when things are tight.
Exactly. They highlighted recent launches like a new Crest 3D white stain remover, an Oral-B IO2 toothbrush, Tide Oxy Boost pods, gain odor defense.
Lots happening in laundry and oral care then.
Yeah, and also things like recyclable packaging for Tide, plus innovations in Pampers, Gillette, and home care brands too. They're also making a point of targeting all price points, trying to capture value shoppers as well as premium buyers.
Makes sense. Are they seeing private label making gains?
Interestingly, they cited data suggesting private label share is actually declining a bit in the US and Europe right now.
Oh, that's counterintuitive in this economy.
It is. Maybe brand loyalty is holding up better than expected. They're also working on simplifying their product ranges, fewer SKUs, and strengthening partnerships with retailers. And that $5 billion opportunity they keep mentioning for brands like Bounty in North America.
Right, getting more households to buy it.
Exactly. That's still a major focus.
Okay, strategy seems clear. But one big cloud is tariffs. How significant is that for P&G?
It's becoming a bigger headache for sure. They put an estimate on an annual pre-tax impact of somewhere between $1 billion and $1.5 billion.
Wow, that's a billion with a B. That's substantial.
It really is. And they expect a hit of about $100 million to $160 million just in this upcoming fourth quarter alone.
Where are the biggest tariff costs coming from?
Seems to be mainly trade between China and the U.S. and also U.S. exports going into Canada.
So what can they do about it? Just absorb the cost?
They're trying to mitigate it, focusing on, again, productivity improvements, looking for more flexibility in where they source materials, and selective price increases where they think they can pass it on.
Does their global footprint help?
It gives them some agility, yeah. Their global supply chain offers options, but making big changes takes time and, careful planning.
Okay, so tariffs are a definite headwind. How does all this translate into their guidance for the rest of the fiscal year? Did they adjust their outlook?
They did. They trimmed their forecast for organic sales growth for the full fiscal year 2025 down slightly, now expecting it to be around 2%.
Only 2% for the full year now.
Yeah. And for the fourth quarter, the final quarter, they're guiding for organic sales growth somewhere between 0.5% and 4.5%, a pretty wide range.
What about earnings per share?
Core EPS is projected between $6.72 and $6.82. That's up 2% to 4% from last year's $6.59. Doing the math, that implies a Q4 EPS of about $1.37 to $1.47.
And headwinds impacting that?
They're still expecting headwinds from commodity costs and foreign exchange, about $200 million each for the year, or 8 cents per share combined. And then those tariffs we just talked about, they're expecting a big hit in Q4 specifically, around 35 cents per share negative impact just from tariffs.
Much. 35 cents just in Q4 from tariffs.
Yeah, it's significant. But despite all that, they're sticking to their plan to return $16 billion to $17 billion to shareholders this fiscal year through dividends and buybacks. And they're maintaining that 90% free cash flow productivity target for the full year, even though Q3 was lower.
Okay, so trimming sales guidance, acknowledging significant headwinds, but still committed to shareholder returns and hitting that cash flow target eventually. If you put it all together, what's the main message for investors from this call?
I think the key takeaway is P&G's resilience. They're navigating a really challenging environment, no doubt about it. Growth has definitely slowed down.
But the brands are holding up.
It seems so. Their brand strength and the continued investment in innovation appear to be protecting their market share, which is crucial. Their focus seems to be on long-term brand health, not just slashing costs for short-term gains.
Which could position them well if or when the market improves.
Exactly. That seems to be the strategy. But the revised guidance clearly reflects those headwinds, tariffs, cautious consumers. It signals a pretty cautious outlook for the next few months.
So investors need to keep watching consumer spending and those tariff impacts very closely.
Absolutely. Those will be key to seeing how P&G performs going forward.
All right, let's shift gears now to our This Is Not Financial Advice segment. Time for some, let's call them outrageous but plausible trade ideas based on this P&G deep dive. What have you got for us?
Okay, idea number one. Think about P&G's consistency, especially that dividend track record we talked about. 69 straight years of increases. They keep returning cash even with headwinds.
Right, the stability factor.
Exactly. So one idea, maybe a bit counterintuitive, could be to go long P&G stock. But to hedge against wider market worries or a consumer slowdown, you could pair it with shorting a basket of consumer discretionary stocks.
The ones that get hit hardest when people cut back spending.
Precisely. Companies really sensitive to economic downturns. The thinking is P&G stability and its dividend yield might offer a cushion, and its essential products could hold up better than non-essentials if things get tough. It's basically a bet on stability outperforming riskier consumer spending.
Interesting. Playing the relative strength and the dividend. Okay, what's trade idea number two?
This one plays on the internal performance differences we saw within P&G itself. Remember how personal healthcare and skincare were strong while baby care dipped a bit?
Yeah, that divergence was noticeable.
So you could consider a long-short equity strategy within the consumer goods space, but mirroring P&G's own performance. Go long companies that compete strongly in those outperforming areas, healthcare, skincare.
Okay, and short.
And short companies that are heavily reliant on the segments where P&G seems weaker right now, like maybe competitors focus purely on baby care.
So you're betting that this performance difference reflects broader sector trends, or maybe even anticipates P&G might restructure somehow?
Sort of. It's a play on that internal portfolio dynamic, maybe anticipating future strategic shifts, spin-offs, M&A, whatever, across the industry as companies try to optimize and unlock value from differently performing parts of their business. It's about capitalizing on those internal variations.
Definitely some unconventional angles there. Food for thought, certainly.
Just ideas to mull over.
Absolutely. And that wraps up our detailed look into Procter & Gamble's latest earnings call. We've covered the key financials, the strategic moves, and the view from management.
And hopefully provided some context around the numbers.
Indeed. And remember, those trade ideas are purely for informational discussion, absolutely not financial advice. Always do your own research.
Definitely.
We'd love to hear what you think about P&G's performance and where they might be headed. Let us know your thoughts. Thanks for tuning in to TalkTickers.